Freedom Builders, and welcome back. My name is Hans Nielsen as always, and I promised you a second video about this strategy called the Dogs of the Dow. If you haven't seen the first video, I'll put a link below here, so I recommend you see the first video first because we are building on the concept here. Today I'm going to show you a couple of variations of the Dogs of the Dow, but in the last part of the video I'm going to discuss a couple of topics with you. Two things that are crucially important if you want to build wealth and financial freedom. So stick on to the end here because they're gonna get some really good stuff in here. First of all, just a quick recap. We talked about the Dogs of the Dow, and the Dogs of the Dow is that we are looking at the 30 Dow Jones stocks, the largest stocks in US and pretty much in the world. And then we are looking at the 10 stocks with the highest dividend yield, meaning that the 10 stocks that are paying out most dividend when you compare it to the stock's own price. The first of the strategy variations I'm going to show it to you today is something called the small dogs, or somebody call them the puppies. And that is because when you are ending up with 10 stocks, some of them will be quite highly priced, and this strategy is pretty good if you don't have so much money in your account and you want a bit lower price stocks. So the small dogs, as this one is called, is that you're looking at the exact same 10 stocks as in the Dow Jones, or sorry, in the Dogs of the Dow strategy. But now you're only picking the 5 stocks with the lowest price. Meaning that, let's say we have 10 stocks and they're starting at maybe $200 and going down, and then we have 80 and we have 60 and we have 25, and then you're picking the 5 stocks with the lowest dollar value. Now this can be a benefit for you if you want not to tie so much money up in these Dogs of Dow strategies. But the argument here is also that these lower price stocks tend to move a bit more quickly in the market. So if you want to squeeze a bit more out of the market, these small dogs might be a thing to start with. Another variation, there's one called the Dow 4, and that is actually where, let's say you have 80 and 60 and 25 and 15 and 8 here. Then instead of, this was just the normal Dogs of the Dow, this was the Dog 5, we can call them, and then there's another strategy saying, hey, we could just remove this one, the lowest price, because it seems like the lowest price maybe is getting too low and there might be a reason for that, and it might be a bad company. So we are only choosing these 4. Now I know the rules are starting to get a bit complex here. We started with the best 10 here, or the 10 with the highest dividend yield, and then in the Dog 5, or the small dogs here, we started with just the 5 of them that had the lowest dollar price. And then in the Dog 4 we deleted this one, cancelled the lowest price one, with the argument that when it's the lowest one it might be worse quality, I don't know. All of these rules you can add on them for eternity. There is even one called the Motley Fools 4, I think it is. It is invented by the guys from the website Motley Fools. And they are saying, well, we are going to look at these 4 here, but we're going to put 40% of our money into this one, and then 20% and 20% and so on these 4 stocks. And now we're getting, I'm going to show you the performance of the different strategies in a second, but now we're going to get to one of the important factors that I want to address here, because what we're doing here is a bit dangerous. Well, it's not me doing it here, but what people are doing here, when we are getting the rules more and more complex, might be quite a dangerous thing to do. Because what we might end up doing here is something called curve fitting, or it might be curve fitting. Curve fitting means that you actually start with a strategy. Let's say the dogs of Dow. We have the 10 stocks. And the argument here is actually quite reasonable that these are huge stocks and they have cycles, and we are trying to catch them in the bottom of the cycle. We might even find a good argument in the small dogs that the smaller stocks might have a tendency to move a bit more up and down. But when we only buy 5 stocks instead of 10, we are running into our first problem, because we are not as diversified. When you have 10 stocks and one of them is doing really poorly, maybe losing 50%, well, then you have 9 more stocks to earn back that 50%. But if you only have 5 stocks and one of them drops 50%, then you only have 4 stocks left to pay back that loss. And that means that your portfolio will eventually get more volatile. We'll see that in the numbers in a second. Now, the curve fitting part is one of the most dangerous things to your portfolio, to your financial well-being. Because what that is that we are starting with a strategy, and it seems like a good strategy, but we are taking a look at the data set, and then we start to what is called massaging the data set. We are trying to find outliers, things that are big losses maybe, and it might be that we find, well, over the last 20 or 30 years, we can see that in 70% of the time maybe the lowest priced here is the worst performers. Alright, let's delete that one. But then maybe we get into the data set and we look some further and we think we might be able to do this even better. And then we find out that in years, I don't know, ending with 3, this strategy is not very good. So we'll rule out all years ending with 3. And in years ending with 5, 7 and 9, we should not use this in May, June and July, because we can see that the numbers are a bit skewed here as well. I think you can see where this is going. At the end, we have taken a curve that goes something like this, which is actually quite a fine curve because we're making money, but then we don't like these drawdowns. So in the data set, we start to pick out all the bad stuff, and we end up pretty much with the curve going like this because we don't like swings. And when you see a curve going almost straight up, we see it in a lot of day trading systems, back tested. We can see these lines going up, making 100% per month. You can be 100% certain that these are curve fitted portfolios. So we don't actually want to make the rules too complicated, or at least we don't want to take the data set and just keep making strange rules actually for taking out the biggest losses. You have to realize that when you invest, when you trade, there will be losses. You cannot win them all, and if that is what you're trying to do, you should not be investing. So that is the first real danger here when we are talking about the dogs of the Dow. I see the argument for the small dogs, it could be real, but when we start to get more and more detail, it is obvious that people are trying to massage the data set, and I would be a bit worried about that. But there is another thing that follows when we start to get fewer and fewer stocks into the system. And I'll show you that on my computer, because we are going to talk about something called standard deviations. It's a statistical area that I want to mention to you, and that will be a part of many videos here. But let's just drop into the computer and I'll show you what I mean. Alright, let's look at some stats first. We have the normal dogs of Dow, and in this statistical schedule here, I actually have data from back from 1972. And we can see that just the standard dogs of Dow over this long period of time has been making 8.3%, and that is up until the end of 2018. And we can see if we compare to the S&P 500, that one is making 7.1%, so we are beating the market. But then we are trying to take a look at the small dogs, or the dogs of Dow 5 here. that one is pretty much better when we look over this long time series here. That one is doing 9.7% instead of 7.1%, which is also very good. But we can see something, and if you look at the numbers, you can see that we have the standard deviations here. At the normal dogs of Dow, we have 16%, but in the small dogs, we are having 19.1%. And standard deviation is simply a number showing us how much movement there is in the portfolio. If we are looking at the numbers and having a statistical middle line, then this standard deviation is showing how large are the swings away from the middle line here. And we can see that the swings are bigger. We can also see it that the best year in the normal dogs of Dow was making 48%, which was amazing. But the worst year, that was in 2008, we had a loss of 41.5%, which is quite hard, but it is possible to survive that one. Now, when we go to the small dogs, we see that the best year is 60%, 60.8%, but the worst year is also way worse. It is 51.5%, also in 2008. And when we're getting above 50%, also 40% actually, most investors will get really nervous, and they'll start to sell the stocks even though that it is against their rules. We can also have a look at the Motley Fool 4, because that one is doing somewhat just like the small dogs actually. It's doing 94%, but here we are only in 4 stocks. And as you remember, the Motley Fool 4 is where we take the small dogs, the 5 smallest stocks, and then we remove the smallest of them, and we put 40% into the second smallest, and then 20% into the others. That is actually not doing better than just the small dogs over a long time span here. But if we look at the years here, we can see that the best year is 88% and the worst year is 64.5%. And we can see that the standard deviation is now up to 25%. And there are some other different variations that I'm not going to mention to you today, where we can see that the best year is 183% for one year, but the worst year is 87% down. And 87% loss. Imagine that you have put $100,000 into the strategy wanting to make a good and decent return, and all of a sudden you only have 13% left. You have 13,000 out of 100,000. That is hard to swallow as an investor. So what we can look at here is that the 2 best strategies is actually the Dow and the dogs of Dow, and then the small dogs, because they're making 8.3 and 9.7% over something like almost 50 years, 45 years or something like that. But the standard deviation is also big, and that is one thing you should remember, that when you get a higher return, then over the long run you will always get a higher risk as well. So the dogs of the Dow can be a reliable strategy, but you need to know that once in a while you'll have a big loss. And that brings me back to another thing, and I'll just jump to the right, to the whiteboard here to explain that to you. Just a second. All right, back at the whiteboard here. First of all, we have the curve fitting part, which is very important not to do. But it's also an easy trap to fall into. I know I've done it before. So there is the curve fitting. Then there is the thing about that, I'm just writing standard deviation here, or risk. That most people forget that when they are about to choose a way to a strategy to invest from, they tend to just look at the absolute return. And if they have a strategy making 12% over 30 years and some strategy making 20%, they're going for the 20% because we want more money, we're greedy. All right, but what if that 20% return per year offered you a couple of years with minus 80%. It is so easy to sit and look back at the statistics and saying, oh yes, I could easily outlive that. I have ice in my stomach, as they say. Well, when you're down 80% and it is money maybe meant for your retirement or buying a new house or a car or holidays, then an 80% loss doesn't seem so attractive. So sometimes the 12% is actually better, because they might only have a drawdown at 20% at any one time as a worst drawdown, and 20% is way easier to go through than 80%. So the risk, people often forget to look at the risk, and they simply tell themselves that, yeah, well, that was once in the past, that is not going to happen again. I know we have a strong stock market and economy and whatsoever. Just remember that things happened. Bad things happened in the stock market. I've been here since 1987, and believe me, I have seen drops in single stocks and markets that you wouldn't believe. So just remember that risk is a part of investing. All right. The last thing that we often do is that we look at long time periods. And that means that a second ago I showed you a statistic on the computer showing that one strategy was way better than the other. Alright, but we were looking back at until 1972, I think it was. So we were looking at almost 50 years. And the structure of the stock market simply changes during different time spans. So maybe in the 1970s and 80s, companies had a tendency of paying out larger dividends, and maybe that got a bit smaller, and the companies started, instead of using the money as paying out dividends, they started to initiate stock buyback programs, for instance, that doesn't show up in the statistics as dividends payouts. So the stock market has definitely changed over the last 50 years. So when we're looking at a huge time span of 50 years, we can't see the average return per year. We can't see the standard deviation, but actually it's okay to look at. But basically, you should only look at the last 10 years, or at least you should look at the time span and see if the dog of Dow is doing great from 1972 up until 2018. Well, is that the same return it is making from maybe 2010 to 2018? What about from 2000 to 2010? And if you can see that the return is pretty stable, it can vary of course, but if it's making 7% per year for the first 10-year span, and then 8.5% for the next 10-year span, and 6% for the next 10-year span, and then maybe 10.5%, then it is quite stable and doesn't have some 10-year spans where it's making minus 5% per year on average. That makes it a good strategy. But don't fall into the trap of looking at a huge time span and saying, well, if I had applied this strategy over the last 100 years, I would be a gazillionaire or something. No, you have to look at recent time, because the structure changes in the stock market. Interest rates drops lower, and we are calculating the numbers in different ways. So just remember that. Don't fall into the trap of curve fitting. Remember to look at the standard deviation and the risk. Don't fall in love with high returns without looking at the risk. And remember that when you're looking at long time periods, you also need to isolate the last 5 and 10 and 15 years and make sure that the strategy doesn't drop in performance. And then you fall in love with the 50-year performance, but the last 10 years have been horrible. All right. That's it for now. We had a couple of different variations for the Dogs of Dow strategy, and then, which is actually the most important thing in this video, I think, we have the stuff that you should be careful of when you are looking at strategies and methods for your investing. What I want for you is a good and stable return, and you can end up with having huge amounts of money if you can just, on a stable way, make 8 or 10 or 12% per year. You don't have to make 20 or 50 or 100% per year to end up being quite wealthy, actually. It's all a matter of the time you're putting into it. So we want stable, we want secure financial future, and we don't want to fall into all the traps. And believe me, I have been all over the place here, so I know what I'm talking about. Remember, if you like this video, remember to subscribe, hit the like button, the bell notification button, all of the buttons you can find. Hit all of them just to tell YouTube that this is important. Alright, I'll talk to you soon. I have a number of good videos coming up. Thanks for your time today. Bye.